the Fed is not going to just sit by and watch their balance sheet shrink by 1.6 trillion. Foreign developed value equities had a great month. The bull case scenario coming into view.
Things have turned a lot better in February. Interesting month for the market. So let's look at the heat map here and go through the returns for February.
We'll take a look at the market summary. So the first column there on the left is for the month of February. And, it looks somewhat similar on a high level to January, but there was a further divergence within the US equity market. So things like value stocks performing very well. So large cap value stocks up 5% in February, small cap value stocks up 9% in February, where, sort of the bellwethers, the large mega cap growth names in the market were flat to negative. So we're seeing that rotation that we've been monitoring since last September really accelerate in February, particularly the last couple weeks of the month.
And a lot of that hinged on the big changes in the rate market, because we saw significant changes accelerating in through February as well, right?
Yeah, definitely. We'll certainly unpack this idea, but the theme within the market that was sort of dominating or emerging started to shift from reopening of the economy, which there are really no negative consequences for any area of the market when the reopening theme is present, to reflation. And that subtle shift implies a pickup in inflation expectations and a pickup in treasury yields, in interest rates. And that has some ramifications most directly for high quality areas of the bond market. You saw the Barclays US Ag Bond Index, which has a huge chunk of that index is US treasuries, and a huge chunk of those treasuries are longer maturity treasuries. Those securities lost value as interest rates rose, particularly on the long end of the curve as those inflation expectations picked up, but also had some ramifications for the equity market. It really accelerated that rotation within the equity market out of, this is the first time where money actually looked like it came out of growth stocks and into value stocks, as opposed to just going into value stocks. So it's accelerated that rotation as well.
Yeah, and we'll take a look at some of that in a few minutes. But on the foreign market side, what in particular was the drivers there?
Yeah, similar themes under the hood when you look at foreign markets. The big winners were any countries, sectors, companies that were tied to a cyclical pickup in economic growth. So think energy, materials, industrials. Generally, that favors more developed market economies, more value-oriented areas of the market. Those were the areas that did well. So foreign developed value equities had a great month, and growth equities in foreign developed markets and emerging markets really flat to slightly negative.
Yeah, and as we see at the bottom of this page, commodities were continued their tear here as we've moved into the second month of this reflation idea here. So, I remember this was about a year ago. You and I were actually down in Florida with client at an event, and commenting on how crazy the low rates were, and look at where we are today.
Yeah. This chart goes back to 2018, and you can see these are yields for different areas of the bond market, and it's just down and to the right has been the primary trend. Obviously, interest rates in most areas of the bond market reaching all-time lows late last year, and just now starting to pick up. A pretty notable move, really the last 2 months, so the first 2 months of 2021, about a 50 basis point, 0.5% uptick in the 10-year Treasury note, and similar at the longer end of the Treasury yield curve. So just starting to see interest rates rise slightly, but still plenty low enough to support valuations, to support rolling over principal, to support the economic recovery.
Right. Yeah. If you thought they were low then, they're still low. And if you expanded this chart out even longer, that long-term bull market in bonds looks still intact here.
Here, looking high level at the S&P 500. So the dark blue line is the S&P 500, just limped if we focus all the way out to the right. sort of limping into the end of February, having a couple negative weeks to end February. But once again, important to note that the majority of the S&P 500 index is now allocated to growth equities and tech areas of the market, tech and consumer, things like the MAGAF stocks. And that area of the market didn't do as well in February, and so that brought down the entire index. There were plenty of areas within the market that did very well during February, mostly value areas. So the overall index sort of limping into the end of the month, but you can see, just taking a longer term perspective, looking at these technicals, we've redefined our trading range as shown with those light blue dashed lines. And no matter what trading range you put, the market is above it. The market is above the trading range. The slope of those dashed blue lines is 18% annualized. So that shows you the strength and the speed of the recovery, and this trading range goes back to early 2019. And then also the 200-day moving average, trading significantly above the 200-day moving average. And the 200-day moving average, that slope is something around 30% recently here. You've seen the green line start to tick up. So any way you slice it, technically the overall market, looking technically perhaps a little overbought, perhaps a little frothy, but really focusing on the pockets of value within the market, we think is the best way to play it.
And as we're sitting here on the precipice of another enormous stimulus package about to be passed, so these numbers all reflecting all of that good news potentially to come from the markets. So this is a great chart to look at the actual changes that are occurring under the surface of the S&P.
Yeah. The chart furthest to the left here, so these are the U.S. equity market barometers. So on the vertical axis, you have market cap, large caps at the top, small caps at the bottom. And then on the horizontal axis, you go from value on the left to growth on the right. So year to date, you can see large growth slightly down 0.4%. Most of those losses, basically all of them, happening in February. And conversely, as you go down into the left, value performing very well, small cap value up over 13%. So this has been, this is a big move for 2 months, but put that in the context of the move that's happened since the beginning of September last year, which we see in the market barometer, just one over right in the middle there. Now you're looking at large growth up a little over 3% since September 1st, but small value up 45% over that short a time period. So really a huge reversal, all predicated on more fiscal stimulus, the market pricing in a blue sweep, a Democratic-led Congress, the Fed not doing anything, and then also with all of the positive vaccine developments, really pricing in that 1.21 gigawatts of money at 10:04 p.m. bull case scenario that we outlined in our annual outlook.
The graph on the far right, since 1/1/2017, still have a ways to go to sort of normalize that, but it's just been an incredible turnaround in 6 short months.
Definitely.
So let's look at the MAGAF. So Microsoft, Apple, Google, Amazon, Facebook, and we've been watching this first bar be significantly higher than all the other bars for a long time, and now we have this big correction here.
Yeah, the furthest to the left, what we're showing there, MAGAF since September 1st, 2020, basically flat. The rest of the S&P 500 in light blue up 28%, which you would look at that and think that's actually a healthier market environment than what we saw for most of 2020. The leadership is far broader. The market environment we saw for most of 2020, looking at those middle bars, was that subset of 5 stocks driving the overwhelming majority of S&P 500 returns. Those 5 stocks up 53%, and they represent 25% of the index. So that's huge. I mean, if for active managers that were underweight those 5 stocks, is really good luck. Hopefully you own Tesla, but that would have been the only way you would have really been able to outperform. Where if you owned anything else in the S&P 500, odds are you weren't going to keep up with the index, which was up 18% last year, and certainly not the MAGAF stocks, which were really the leaders. All the developments thus far year to date have led to an increased probability of our bull case scenario. So the bull case scenario coming into view. Now it's important to note on this slide, we don't adjust the probabilities dynamically throughout the year. What we set at the end of December is what it is. But if we were to restrike these probabilities, we would probably take a little bit out of the base case and put a little more into the bull case, the 1.21 gigawatts of money at 10:04 p.m. And the major developments there that we're seeing that are making the bull case a higher probability occurrence are the Democrats going through and looking like they're going to be able to go alone and move forward with the 1.9 trillion COVID relief bill. So that's one big factor. The other factor that is often overlooked, a bit nuanced, is the mechanism with which the Treasury is going to use to pay for the COVID relief bill. So Janet Yellen has signaled that the primary way they're going to come up with the 1.9 trillion is by drawing down the Treasury's account at the Fed. So the Treasury has 1.6 trillion roughly dollars on account at the Fed, and they intend to draw that down for the relief bill. And so why that matters is because the Fed is not going to just sit by and watch their balance sheet shrink by 1.6 trillion. They're going to have to go out and buy 1.6 trillion additional dollars worth of securities to get their balance sheet back up to the level it was. Plus, they're still doing $120 billion of purchases a month. So you can see we're talking about big numbers. You're getting towards 1.21 gigawatts here, however large that number is. And then the last thing is on the vaccine front. So we've seen a pretty dramatic uptick in the percentage of vaccines in the US and even globally that have been distributed that are actually finding their way into the arms of individuals. And so that is doing a lot to break the link between case counts, which are falling anyway, which is great, and COVID outcomes, meaning hospitalizations and deaths. So our COVID timeline, when we look at the pace of vaccine distributions, our view is still once we get into mid-April, early May, the at-risk population in the US, if they wanted a vaccine, they should have been able to get it. And that the mortality rate and the hospitalization rate of this virus should drop dramatically and free up a tremendous amount of hospital capacity and allow policymakers to reopen the economy with minimal consequences on the virus front.
Thanks. That was a great update, and we'll look forward to March and the warming of the weather up here, and potentially some golf in our future. And for the viewers, if you have any questions about our outlook, just let us know. We're always happy to have discussions with you. So enjoy your day.